In this week's market update, hurricanes wreak havoc with the US jobs data, Catalonia faces off against Madrid, and another earnings season gets underway. After years of steady improvement in the US jobs market, Friday's non-farm payrolls data came as quite a shock. 33,000 fewer jobs were created in September, the first decline since 2010. There was, however, a pretty easy explanation. Hurricanes Harvey and Irma blew through the jobs market just like they'd cut a swathe through the Caribbean and Florida. The likelihood is that the latest figures are a one-off that will bounce back in the coming months. The other reason to treat the non-farm payrolls as a blip were the rest of the data package on Friday. The unemployment rate continued its post-crisis slide to a historically low 4.2%, and unsurprisingly, with such a tight jobs market, wage growth also picked up to 2.9%. That will probably convince the Federal Reserve that it's right to be squeezing monetary policy back to a semblance of normality. The odds on a rate hike in December are now close to a racing certainty, with probably 3 further rate hikes looking likely next year. Combined with the planned reduction in the size of the Fed's bloated balance sheet, the US is clearly on the path to policy normalisation, even if the process will be relatively slow and end up at a lower level of interest rates than in previous cycles. Given all this, eyes will be on the Fed's minutes from its latest meeting, due to be announced on Wednesday. Janet Yellen, whose term of office ends in February, looks like she's determined to hand the job over with the normalisation process well underway. The other main focus this week in America for investors will be the start of another quarterly earnings season. As usual, the banks are kicking things off. JP Morgan Chase and Citigroup are due to announce on Thursday, with Bank of America and Wells Fargo following up on Friday. Now, no one is holding their breath for very much from the big banks. Markets have been quiet, and falls of trading revenues for the big investment banks are expected to reach 15 or 20%. Low interest rates have not helped, as these reduce the profit spread on loans. Growth in lending has also been lacklustre. The only bright spot looks like being credit cards, where Citi is strong. Sticking with the US, the week rounds off with inflation data. The Consumer Prices Index is expected to show a 0.6% advance in September after a 0.4% gain in August. The rise in the oil price is a major factor, with petrol prices surging early in the month as the bad weather also hit refining capacity. Retail sales will wrap up the US economic snapshot also on Friday. Now, on this side of the Atlantic, the main focus this week has of course been the ongoing crisis in Catalonia, where the regional government continues to toy with a declaration of independence which would plunge Spain into a deep constitutional crisis. Madrid has already said that it would consider any such declaration as illegal, and the central government would most likely revoke the autonomy that Catalonia enjoys and impose direct rule. With the region split between those wishing to remain a part of Spain and those wanting to leave, it's unclear what will happen next. Now, Catalonia's future is significant because it's the richest region in Spain, and it accounts for around a fifth of the country's economic output. Crucially, the EU's leaders have remained silent on the future of the region, nervous that secession could lead to similar calls for independence elsewhere in what is still a fragmented continent. Significantly, there remains considerable opposition to the creation of a breakaway state from individuals, many of whom protested over the weekend, but also from businesses, some of which have moved their headquarters out of Catalonia as a precautionary measure to perceived safer locations elsewhere in Spain. Hopes for a negotiated settlement to prevent a breakup helped reverse some of last week's negative market movements after the weekend. The yield on 10-year sovereign bonds slipped as the debt came back into favour. It was down 4 basis points to 1.63%. That compared with a peak last week of 1.81%. Stocks on Madrid's IBEX 35 benchmark were also up, led by the Catalonia-based banks that were hardest hit last week. Last week, investors had pulled out more money from Spanish funds than in any week since November 2014, and that was when the Catalan government last held an independence vote. In total, $229 million was pulled out of dedicated Spanish funds. However, just as one European crisis seemed to ease a bit, another kicked off as the Turkish lira fell by as much as 6.6% against the dollar. That was an 8-month low, and it followed the US stopping processing visas in Turkey after the arrest of a US embassy employee last week and a brewing diplomatic crisis between the two countries. Turkey has arrested at least a dozen US citizens in the past year, holding them under as yet unproven allegations of allegiance to Fethullah Gulen. He's a self-exiled Islamic preacher. He lives in Pennsylvania. Turkey has tried to extradite him, but to no avail. On this side of the channel, it's all been about Brexit and the deepening crisis within the ruling Conservative Party. After a disastrous speech at the party conference last week, Prime Minister Theresa May is now facing calls to sack her Foreign Secretary Boris Johnson. He's accused by supporters of the PM of disloyalty. Now, it's unclear whether in the wake of the Conservatives' failure to achieve a majority in the snap election earlier this year, she has the authority to discipline her main rival in this way. The Conservative rifts create an unhelpful backdrop to the 5th round of Brexit negotiations, which are underway this week. The UK is hoping to persuade its EU partners to move on from talking about divorce terms to the more substantive issue of Britain's ongoing relationship with Europe. Meanwhile, former Deputy Prime Minister Nick Clegg has stirred the pot with the publication this week of a book provocatively titled How to Stop Brexit. As if Britain didn't have enough on its plate with the European question, its precarious economic position has been highlighted in the past week by a worrying second quarter in a row of declining productivity data. These showed a 0.1% fall in the level of output per hour worked by British workers between April and June. That followed a 0.5% decline in the first 3 months of the year. So overall, the British economy is now no more productive than it was 10 years ago, just before the financial crisis. Britain is also 15% less productive than the average of G7 countries. So effectively, they produce nearly as much between Monday and Thursday as Britain does all week. The significance of this is a headache for Chancellor Philip Hammond as he prepares his November budget statement. Lower productivity equals less economic growth, which leads in turn to lower tax revenues. The Office for Budget Responsibility reckons that this will knock a big hole in its projections for the public finances. Specifically, something like 2/3 of the £26 billion which the Chancellor set aside to provide a Brexit cushion for the British economy will have evaporated as a consequence of this decline in productivity. In the firing line, thanks to heightened political and economic uncertainty, has been the pound. Having reached a high of $1.36 recently, on the back of expectations that the Bank of England is moving towards a first rate hike in more than a decade, sterling has slid back towards $1.30.